Samiran Chakraborty also with us this morning. Remember, we're watching out for those GDP estimates. Samiran, good to have you with us. Anticipating growth this time around, what are your key parameters that you will be tracking on those numbers? Where do you expect to see the contribution coming in from?
This is probably going to be the first post-pandemic quarter when GDP growth will turn positive. And we think that the headline GDP could print around 2%. And the things that we're going to look at is that the high-frequency indicator, anyway, they were suggesting that December was a better quarter compared to the September quarter. But specifically on the GDP front, there are three things that we will be looking for. One is that most of the company earnings have been showing significant year-over-year growth. And that feeds into the GDP numbers directly. That would mean that segments like manufacturing should do reasonably well. Now, the second thing that we're looking for is that the GST revenue collection in this quarter was first time positive after the pandemic, and it was a reversal from the September quarter. And GST has a very good correlation with the trade, hotels, transport, that segment of GDP. So we expect that segment also to do reasonably well. And the third thing is government expenditure. As you know, in the September quarter, government expenditure was negative year over year. But in the December quarter, it had a very sharp rebound. X of interest payment and subsidies, government expenditure went up by almost 18% year over year. So we expect that component of public administration also to turn significantly positive in this quarter and support the overall GDP growth number.
Okay, fair enough. So definitely seeing that. Do you feel perhaps that, there are some concerns, on the back of the recovery being a little patchy and not necessarily across the board? Do you see that being a cause for concern at this point of time, or in terms of, headline metrics? How do you feel these numbers are going to be read going forward, given the government's been so gung-ho on boosting growth, and at this point everyone's view on India is becoming very favorable in light of one of the economies that's actually emerging slightly better off post the pandemic?
So there are three things, three concerns that we have. The first one is that it's very difficult to distinguish between how much of this recovery is because of pent-up demand and the stimulus from the government and RBI, both fiscal and monetary stimulus. So it's only in a couple of quarters down the line we would have a better sense of what the true extent of the growth is, which is shorn of the pent-up demand and the stimulus. The second thing we are worried about a little bit is the widening income inequality, the so-called cliched K-shaped recovery, that there are certain benefits happening to the larger players in the economy. There are benefits happening to people who have been able to work from home, but that is not percolating into the lower strata. So that's an element which we would be closely watching. And the third one is it's very difficult to take a call on the progression of the virus, whether we are going to see a second wave coming in India or not. So that risk will always stay with us, at what pace we will be able to vaccinate the entire population, because that will determine how quickly urban consumer sentiment comes back. And that's the only segment of the economy which is not still in full throttle. So these are the three risks that I would be highlighting going forward, but still overall think that we have done much better than what we would have feared 6 months back.
Okay. Samiran, in terms of monetary policy as well, and how that's kind of aligning at this point of time, do you see any reason for further policy changes in light of the kind of recovery that we're seeing?
Well, it's quite obvious from RBI's forward guidance that RBI wants to keep the exceptionally accommodative monetary policy continue well into FY22. So I guess that's something which is more or less given now. But the problem is that there are things which are beyond the control of RBI. And again, let me highlight three things. One is the huge borrowing program of the government. Second is US 10-year Treasury yields. And the third is oil prices. Now, this combination of these three could exert significant pressure on our own bond yields, and to that extent neutralize the accommodative stance of RBI. And in some sense, one can say that RBI will have to fight this battle for next few months, that while its accommodative stance remains, other forces can shape the at least the market rates in a completely different direction. But still, I would think that the entire 2021 will be more about simply liquidity management for RBI. Rate hikes, if at all, they are a story of 2022, not of 2021 at all.
Okay. Samiran, on the subject of inflation, though, what is your own estimate of how the trend is actually going to move?
So it's very somewhat peculiar that India might decouple from the rest of the world on inflation, while we are quite aware that globally commodity prices have moved up quite significantly, exerting pressure on particularly advanced economy inflation. But in India, at least if I look at the CPI, there's only 7% of the CPI basket, which you can call imported basket. That imported basket, by the way, is growing at some 13-14% year over year. So there's significant pressure there, but it's such a small part of the basket that it's not going to move the needle on overall headline inflation number. And in particular, if you look at the large part of our basket, which is food, there only sugar and edible oil, they have some good correlation with global prices. But rest of the commodities are typically more determined by domestic conditions rather than global conditions. And if we have a good monsoon, et cetera, then food prices in India could stay decoupled from global food price trends. And that's why we think that an average inflation for FY22 in the 4.5 to 5 range is probably a good number to track right now. That way, we will stay somewhat decoupled from global inflation. Our big worry is that if growth recovers much faster than what we are anticipating, then there is a risk that the services inflation part might spike up because it has been subdued during the pandemic times. So that's the only cause of worry for us right now.
Interesting. We'll keep chatting with you as more trends for commodity prices going up actually emerge. Good to have you on the show, Samiran. Thanks for taking the time out.
Thank you.